Welcome back. You're watching Stock Watch this week, and joining me to unpack your stock-related questions this afternoon is Chantal Marx from FNB Wealth and Investments. Be sure to send us your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, Chantal. The rand is roaring.
The rand is indeed roaring.
Why?
But the equity market is not.
Yes. What is going on there?
Yeah. So I think that the rand really wants to strengthen. The rand tends to be quite a momentum-driven currency, and there definitely seems to be some kind of downward pressure on that exchange rate with the US dollar. And I see that the rand is also stronger against the euro and the pound. So generally some pretty decent strength coming through. But yeah, as I say, I think it's probably technical, and it could just be a function of the rand wanting to be stronger.
Could this be the time to send your money overseas and nibble on NVIDIA?
So I think that the rand could actually still strengthen quite a bit from here, but this is a pretty decent level from a longer term perspective. So if you look at the long term fair valuation range of the rand, it does tend to depreciate over time, and we are probably closer to fair value now. What I would say though is the rand tends to over and undershoot fair value quite substantially when it's in an either a weakening or a strengthening kind of trend. So I would actually start taking a little bit of money offshore, but perhaps be patient as well, because we could still see some more strength ahead.
All right. Well, Chantal, let us get to the questions that have come through. Quite an interesting one that we have over here. Will the JSE likely be affected in a negative way when the funds from the two-pot the savings part of the two-pot retirement system, when the funds are withdrawn and made available to the public? I'm wondering why in a negative way, because the narrative has been that it's going to add some liquidity for people to invest and also to buy from some of the companies that are listed on the JSE.
Yeah, so I don't necessarily think people are going to be using that money to invest, because then the money is already invested in their retirement savings. So they're actually just taking money out, paying tax on it, and then investing again. So that wouldn't be the prudent approach. I think people are withdrawing in order to spend or to pay down debt. So I think the net impact on the JSE is going to be quite positive for banks and quite positive for the retailers, particularly the discretionary retailers like the clothing guys and the furniture guys, as well as the building materials companies that are listed on the JSE. Where we could see some negative impact could be in the asset managers and insurance, but relative to their overall assets under management, the expected withdrawals is going to be quite small. So it will be a little bit of a blip, but it shouldn't have a major impact. And then when we think about flows, because obviously the money that is being taken out of certain assets, we think most of that is going to come from bond and cash holdings within those retirement savings, and not necessarily the equity market.
Because exactly. Thank you actually for pointing that out, because I was going to ask, in terms of the insurers and the retirement fund administrators, because, for example, Momentum has been very encouraging and encouraged about the two-pot system. So it's great that you've also noted that it might just only be a short-term blip, but really does nothing to the overall picture over there. Chantal, let's go on to more questions that have come through. There are quite a lot of questions on the PGMs, and of course we've had Northam Platinum, Impala Platinum out this week, a few weeks after Amplat. Quite a few things that they are saying, including Impala, saying that they're not going to be building any new mines because of the threat of EVs. Just firstly, what have you made of those numbers and kind of gauging where we are in the cycle there?
So the numbers have been weak, and understandably so, because we have PGM prices extremely depressed at the moment, while on the mines, cost inflation continues to go up. So there's a natural pressuring of margins, there's a natural pressure on cash flows. So what I've seen from these results haven't really surprised me. Additionally, some of them have a bit of debt, like Impala, and that debt is now being, it's now, there's going to be interest that needs to be paid on that debt at very high interest rates. So nothing from what I've seen so far has surprised me. I do think that the narrative around PGMs is quite interesting, because on the one hand, you have PGM fundamentals showing you that PGMs are still in deficit. But on the other end, there's a lot of question marks about longer term. What are we going to be using this stuff for if EVs displace internal combustion engines?
Yeah.
I think it's probably overly negative because it will take a very long time. And we've also started seeing a resurgence in hybrid vehicle sales, and their PGM loadings are very high. And I know that the Platinum Investment Council is also really pushing the narrative that there are other newer technologies in which PGMs are being applied to. The last thing I'll say about it is the interesting thing about the PGM market and PGM stocks is just when you think there's absolutely no hope, they generally surprise you.
True. Chantal, I mean, do you think the conversation around PGMs is really the same as coal, where there's obviously people who will talk about the long-term future of coal and PGMs, but right now, or at least for maybe the next 10 years, those counters will still be there and will still be thriving?
Yeah, so the demand isn't going anywhere anytime soon. I think that you could start seeing a tapering of demand over time, and that's very similar to what we're seeing in the coal industry. I guess the key difference is that there's a massive push towards getting away from coal because of its negative impact on the environment, where PGMs actually, their main use case has a positive impact on the environment because they're used in catalytic converters that reduces pollutants that get pushed into the air by internal combustion engines. So in that case, it's a little bit different, because I don't think that the PGM market is going to have trouble with stuff like financing and expansion if they get that opportunity, whereas I think with coal that could be the case. But very similar in that narrative from a demand perspective. I think for PGMs, there's a question mark around where is that next leg of demand going to come from. With coal, we don't want a next leg of demand.
Okay, all right. We'll talk about demand because as we were talking about the two-pot system, I'm sure there's going to be increased demand for the clothing retailers. There's a question here on TFG. I'm looking to buy and hold the Foschini Group. Your panel's view, your view, Chantal, on the business.
So we've had a lot of questions from clients as well around whether or not it's too late to get involved in the clothing retailers. Mr. Price and TFG and the other ones have already run quite hard after, like in the run-up to the elections, after the elections, the GNU story. Now we've got the prospect of lower interest rates and lower inflation, two-pot system, everything kind of going in their way, and we've seen those share prices run quite substantially. I think that there's still a long-term investment case even at these levels. The multiples that they're trading at are not very far away from their 10-year averages, which means that the share price gains and the earnings expectations have kind of matched one another on average over that period. So I think we actually have a chance that we could see earnings upgrades to some of these retailers, particularly because of some of the cyclical components that we have in our favor right now. And then there's a structural story as well. Consumer confidence is a massive boon to discretionary retail. And I think that the market could be underestimating just how quickly South Africans can start feeling good about their prospects when things are stable. And when they have electricity.
Indeed. Well, something else that people are feeling good about today is Pick n Pay. I see that share price is up more than 4% currently. Of course, this is after they released that announcement after market close yesterday. Are you with the choir, Chantal, or maybe not at this point?
I've got one foot inside the choir and one foot on my eye. Like I've got an eye on a solo career as well. And I'll explain that now. So I do think that there's an investment case in Pick n Pay, because I think even without doing much, the economic environment and the consumer confidence story we just spoke about is going to be really positive from a grocery perspective. And that's the business that has really been struggling. On the ground, I've also seen a major difference in terms of their push towards offering value to consumers. Just as an example, we buy a lot of nappies in this house.
Yeah.
And we actually are now starting to compare, well, what does it cost on Checker 6060? What does it cost on Pick and Pay ASAP? It's cheaper at Pick and Pay, so let's just buy all our groceries there. So these things do have an impact, and I think without doing much, they'll be able to push through some growth in that business. The Boxer IPO is going to help unlock value because they'll hold on to a stake of it, so we'll be able to see what the market value for Boxer is, and that will certainly help them. With what I mean with my solo career is I think Boxer is a fantastic business.
Yeah.
So the question is, do you want to be in Pick and Pay and own a bit of Boxer and maybe have a still struggling or kind of hope of a turnaround in grocery? Or do you just want to get involved with Boxer directly, which you'll have the opportunity to do later this year?
All right. Okay, well, that's a very interesting one, and you actually are even right, because I think ever since Sean took over, I'm seeing more specials, particularly linked to the Smart Shopper card on Pick and Pay. So they're really competing there with the Checkers 6060. Chantal, let's go into banking. Is the stock still a buy? Nedbank.
Nedbank.
Yes.
So the banks generally, I think, have run quite hard over the last few months. So I think when you're looking at taking a specific bank exposure, you would want to look at the ones that have kind of underperformed.
Yes.
ABSA kind of stands out as one of the banks that have not really rallied as hard as the rest of them. Nedbank recently has done quite well. I think if you have a long-term investment view, I would still want to have exposure to the banks. I think that they are heavily exposed to a growing South African economy, but I think your entry points could be a little bit better. So from my perspective, what I think could happen is that you could continue to see kind of support for transaction activity, but there could be pressure on net interest margins because of lower interest rates. And then I think the South African bonds have run very, very hard, probably away from where they should trade on a fair basis. And I think that there's a chance that you could see a correction in SA bonds, and you could then also see a correction in SA banks as a result. So my thinking would be there'd be a better opportunity to get bank exposure again, probably not at the levels you had prior to the election, but definitely off these massive highs that we're seeing currently.
Chantal, another interesting stock that I've been watching over the last week, and particularly over the last 4 days, is Italtile. I think it did get a bit of a boost in its stock on the day that it released results, but then since then the stock has just been going down and down and down. And I'm wondering, what's responsible? Is this just the kind of volatility that we can expect to see on the stock? I do remember, I think you chose either Italtile or Cashbuild, I can't remember, and you said that you might actually be early to go into that kind of stock.
Yeah, so I mean, we like both Italtile and Cashbuild currently as entry points for a longer term investment. Cashbuild probably my main pick, just because of its broader exposure to different areas of the South African market from an income perspective. But Italtile, I think, probably will benefit from the same themes that we mentioned around TFG as well. So consumer confidence picking up will be very positive for these guys. And both of these companies have shown a bit of a shift in revenue momentum. So last year, if you were looking at Cashbuild and Italtile, revenue going down, revenue going down, revenue going down. And now we're starting to see revenue either going less down or actually increasing slightly. And to me, that signals that we're seeing a shift in the cycle. The same thing we're seeing in the South African official retail sales numbers that comes out of Stats SA. We're starting to see a shift in that paint and hardware category. And I think with these tailwinds, both of those companies will do well. Why the stock was weak after results, after initially popping up, the results weren't great, but they were never going to be great because you are looking at a year back where things looked completely different from a consumer perspective. High interest rates, high inflation, low consumer confidence, and certainly going into the elections. These are all things that are reflected in those numbers. on top of some other challenges as well. We still had load shedding 6 months ago. We still had a massive port challenges. So Italtile being an importer as well would have been impacted by that. So just a lot of stuff going on in this past year worth of results that probably won't be exactly the same or as bad going forward, and likely actually turn into tailwinds when it comes to inflation and interest rates.
All right. Chantal, before we go to your stock pick, there is a question here, your take on Master Drilling. We did talk about it sometime during the week, but just a recap on why you like the stock.
Yes, so I mean, Master Drilling is just an incredibly well-run business. They are excellent allocators of capital, and the management team is really passionate about what they do. And what they do extremely well. They drill massive holes in the ground. That's basically the premise of what they do. But the machines that they develop and that they use is of it's technologically advanced. It's their own IP, and they actually ship these machines all over the world in order to participate in mainly the mining industry, but also the construction sector to a certain extent. The company trades on a 5x forward PE, but you have expected growth going forward in the double-digit percentages. It should not be this cheap. They don't have a lot of debt. They have massive cash generation capability. And I do think, particularly in the mining sector, we could actually start seeing a shift in capital expenditure, because a lot of mining companies have been underinvesting in capacity for years. So there'll be an incentive for them to put more holes in the ground, and Master Drilling will be the guys to drill those holes.
All right. Well, talking about companies that you are bullish on, Chantal, your stock pick, and actually there is a question on that. I know your stock pick is capital appreciation. There's a comment here. Seems to finally be getting the recognition it deserves with a nice run-up to R1.50. And you are part of the people that are giving it recognition.
Yes, so up until about 3 weeks ago, I didn't know a lot about the stock, but I've been reading up on capital appreciation, looking at their financial statements and the investment case behind it, as well as the valuation, and it is quite compelling. So it's a fintech company. The biggest portion of their business, or the business that will be most well known, is on these transaction terminals that you get at shops.
Yes.
They basically sell or rent those terminals to the big banks in South Africa, who then put them in shops. So that is the main part of the business. But they also run the software that goes into those terminals, and they also innovate around what those terminals can do. It's a really, really solid business. They've grown from zero revenue when they listed a few years back to over R1 billion worth of revenue now, and a lot of that income is annuity income. It translates into really strong cash flows. They have absolutely no debt, and they're paying a really, really nice dividend. So by our calculations, we're looking at a forward PE of 7x, which is super cheap for a company expected to grow earnings by 30% over the next couple of years, and a dividend yield of 9.3%. So, I think it's incredibly well run. Again, a very energized management team, very passionate about their business. And I foresee good things for this company going forward.
All right. Well, I foresee good things for the weekend that is coming up, Chantal. Thank you so much for your time and for your analysis today. That was Chantal Marx from FNB Wealth and Investments.